Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to be discussing buying real estate for appreciation versus cash flow. So in episodes SS2 and SS3, I discuss buying properties and choosing target markets that will give you a mix of both cash flow and appreciation. But today, I want to dive deeper into both strategies. So appreciation comes about as a result of growth in the underlying property in which you own equity. Cash flow is when you receive income for renting out your property that exceeds all of your expenses and taxes. So what strategy do experienced real estate investors focus on? Well, they're going to focus on both of them using a metric called internal rate of return, or IRR, which is used in financial analysis to estimate the profitability of potential investments. Now, it excludes external factors, hence the name internal, such as the risk-free rate of return, inflation, and the cost of capital. But it allows you to compare two investment opportunities and know which one might be better suited for you and your capital. So how do you calculate the IRR? Well, very simply, let's assume the property costs $100,000 and it'll generate $12,000 annually and grow by $6,000 in value for each of the next 5 years. In this case, the IRR would be 18%. While these are and will remain best guesses, the more experience you get, the more realistic your projections will end up being. But what strategy are we really focusing on? Well, we're focusing on cash flow. And the reason why we focus on cash flow is it's very easy to estimate future returns with cash flow. Rents normally do not decline in a pullback. Rents will usually increase in a normal market or a growing market portion of the market cycle, and expenses will usually increase at or just above inflation in either market. For example, a $2,000 monthly payment, which includes taxes, principal, interest, and insurance, the biggest part of that, principal and interest, will not be increasing if there's any pullback. Taxes will most likely not increase because property values are most likely going down. And insurance and common area utilities will only increase by a few percent. So if your insurance portion of your payment is $2,000 per year and it goes up by 5%, that is a $100 annual increase, $8 a month. And that's easy to be spread upon new renters that you have coming in or current renters you have when you're signing your next year's lease. With appreciation-only strategy, what happens when there is a pullback is the only way you make money is when you sell. Cost to sell are usually about 10%, not counting income taxes. Now, when I'm saying that, I'm including state, county, and city fees and taxes and everything like that. Obviously, we're not talking income tax and any of this. It's just the fees with your agent. Usually comes to somewhere around 10%. So if you're buying property for $100,000, that property has to go to $110,000, $111,000 just for you to break even after all the fees. Remember, the value of your property when you're investing for cash flow only matters when you buy, sell, or refinance. Other than that, it's just a number on your financial statement. When you're buying for cash flow, I like it because I can make money in an up, down, and sideways market. It's very difficult to make money when you're buying for mainly or all appreciation in a market that's going down or sideways, unless you've purchased at a dramatic discount. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. Look forward to 2 more episodes next week. See you then.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.